Good morning. I'm Jim Mintert, Director of the Center for Commercial Agriculture here at Purdue, and I want to welcome you to our webinar, which is really focused on long-term cash rent decisions, which of course has been a big issue in agriculture these last few months and will continue to be an issue going forward. Joining me today on our program is my colleague, Dr. Michael Langemeyer. Dr. Langemeyer is the Associate Director of the Center for Commercial Agriculture as well as a professor in agricultural economics. I want to make you aware of some resources that we have on the Center for Commercial Agriculture's website that perhaps you haven't seen. On the home page of our website is an article that discusses some of the material that we're going to cover in today's webinar. And as you look at the home page for the website, you'll discover it's organized into 4 basic quadrants. One of those quadrants is called Featured Publications. And near the bottom of that group of publications, you'll find an article entitled Evaluating Your Farmland Rental Options. If you click on that, that's an article that discusses this cash rent decision-making process, and in particular the cash rent decision-making tool that we've put together along with our colleague at the University of Illinois, Gary Schnitke. And within the article itself, you'll find a link to download the Excel spreadsheet, which we're going to be demonstrating a little bit later in the program. So the website address is there on the left side of your screen, ag.purdue.edu, commercial ag, or you can simply type in your favorite search engine, Center for Commercial Agriculture, and we should pop up number 1 in the results. So some additional resources that you might want to tap into on our website as well on this topic. Again, if you go to the home page of the website and look across the menus at the top, you'll discover one of those menu items is entitled Farmland. Click on that. There should be a drop-down menu under that. And on that drop-down menu, one of the options will be rental arrangements. And if you look at that, there's going to be several different resources that you can look at with respect to discussing different types of rental arrangements, as well as some sample lease forms. So as you think about the issues related to cash rent and farmland leasing issues here over the next few months and beyond, those are some good resources for you to tap into that we think will be somewhat helpful. Michael, let's talk a little bit about why we're even having this discussion about cash rent. And this slide, I think, maybe helps set the stage a little bit. So on the vertical axis, we've got revenues and cost per acre by year going back to 2005 with some projections on the slide going out to 2018. And of course from 2005, 2006 up through 2012, we were in a very profitable environment in agriculture with crop prices rising faster than cost, very positive margins. Those positive margins had a little bit of a downside because, and that's really what we're dealing with today, because that's what actually contributed to the very high cash rental rates we're currently trying to address or deal with today.
Yeah, definitely. As the revenue increased from 2007 to 2013, that was a particularly high increases during that period. The cash rent went up too. And in fact, the last 10 years, from about 2005 to 2014, cash rent doubled in West Central Indiana, for example.
So that, as prices have come down, costs have started to come down, but our challenge is that crop prices have been falling faster than cost, producing some very negative margins. And that's really created this cash rent dilemma or situation that we're facing right now. So as we think about the cost situation in agriculture, I thought it'd be useful to look at it from kind of a bucket standpoint. And what are the big buckets of cost? You might walk through those a little bit, Michael.
If the 4 big buckets are enumerated here on this slide: cash rent, machinery and family living, fertilizer, and seed. Today we're focusing on cash rent. In some previous webinars, we've talked a little bit more about fertilizer, seed, machinery, and family living. But I want to focus a little bit on 1 and 2, and then talk specifically about 1. If you look at 1 and 2, those are considered overhead costs. And so those are costs that you're going to have to incur every year But look at how big a percent those are. Those represent about 45% of total costs, and so agriculture has a lot of fixed assets, land being one of them, but also we have machinery investment, and we also have family living that we need to support. That makes it very challenging when prices come down, because oftentimes it's very difficult to change these fixed assets and to change the prices of these fixed assets. And so that's why we're doing this webinar. Is cash rent's one of the big ones in fixed assets and cost and cost buckets. As you can see on this slide, cash rent represents 27%. 27% of total corn costs. If we were looking at soybeans, it'd be closer to 35%. And so cash rent's a big cost item. It's a cost item that's difficult to adjust.
And I guess the other point we want to make, Michael, is the fact that although that is the biggest bucket on the screen, there are some other big ones, right? And we're not going to address those today, but if we think about fertilizer cost, we think about seed cost, perhaps pesticide cost, there's opportunities to make some adjustment in those cost factors as well. But the big bucket is still cash rent, and that's the one we want to talk about today. But there's some opportunities. We'll actually be talking about that in some future webinars. So there could be some other things we could change, but we wanted to focus on at least the big, what we view to be the big item. So we're really talking about the cash rent dilemma from a farmer's standpoint. And the dilemma is really this long run perspective, right? If cash rent was just a 1 year at a time decision, it wouldn't be that difficult. But the challenge we face in agriculture is we've got a downturn in expected net returns for corn and beans. We've got landowners that have watched these cash rents rise over a period of years and are also facing some higher cost on their end, and particularly farmland taxes is one of the issues. They're reluctant to reduce cash rents just in response to the downturn in revenues that we're looking at. So we've got some questions to address.
Before we get to the questions, one of the things that's very important to note, and this isn't just based on recent history, but if you go back 40, 50 years and kind of look at the relationship between net returns for crops and cash rent, you're going to see very, very clearly that net returns for crops are very variable compared to cash rent. So it's very important to keep in mind. Net returns are down substantially in 15 and 16, and probably going to stay fairly low in 17. That doesn't mean that cash rent's going to adjust as fast as net returns for crops, and so that's the dilemma. The net returns they're variable compared to cash rents, and so we have to keep that in mind. This is not just a current situation. This is a situation that happens in agriculture. It's just the nature of the beast, and so that's related to the questions we're talking about here. In 2016, it looks like in a lot of cases, in fact, probably most cases, it looks like the cash rent's going to be above break-even cash rent. And so the real question is there, if we're not going to break even on a particular tract of land, should we continue to rent that tract? Well, as all things in economics, Jim, the answer is it depends. It depends on how big that difference is between the market cash rent and the break-even cash rent. And we're calling this the premium. And so let me make sure we're very clear on that right away here. The premium is equal to the market cash rent minus the break-even cash rent. Obviously, it makes a difference if that premium is $10, $20, or $120. And so how big that premium in 2016 is a very important factor, but this isn't just a 2016 issue. This is an issue that's probably going to be recurring perhaps for as long as 5 years. And so we may have to pay a premium for not just 2016, we may have to pay a premium, it'd probably be smaller, we may have to pay a premium for the next several years. And so obviously we want to look at this in a more long-term situation. That's obviously the title of the slide here. We don't want to just look at this from 2016 standpoint, we want to look at the next 5 years. But also, when we're looking at this cash rent decision, and we're looking at this premium, we have to see how this premium impacts our liquidity, specifically working capital. We've talked about working capital in previous webinars, but working capital essentially is current assets minus current liabilities, where current assets are primarily cash and and grain inventories. That's the primary current assets on a farm. You also have prepaid expenses related to fertilizer and seed and supplies as current assets. And your current liabilities are your debt obligations on operating loans for the next year, and also your principal payment on long-term loans, on land loans and machinery loans for the upcoming year. And so you take current assets minus current liabilities, you get this working capital. It's also referred to as liquidity. And so we want to see how these premiums we have to pay impacts liquidity. And the real issue here is if you have to pay a pretty large premium, that's going to decrease your liquidity, which really decreases your flexibility in terms of being able to pay these premiums. But also liquidity is what helps pay for things like new machines. And so we want to guard our liquidity pretty carefully, for a lot of different reasons.
And as you think about it, Michael, the other issue there, not only liquidity, but longer term, as we've looked at some individual situations, you could get into some solvency problems, particularly as you look 3 and 4 and 5 years down the road. So we want to avoid those kind of issues by preserving that working capital today, and that's really what the spreadsheet's about, is helping us figure out where we're going, not just on a one-year basis, but on a multi-year basis.
And here we're focusing on cash rent premiums and liquidity, but obviously liquidity is also used for cash flow shortfalls. And so if you've used your liquidity by bidding up cash rent or keeping your cash rent where it currently is, if you use the liquidity for that, how are you going to cover the cash shortfalls that may be coming up next fall and the fall after?
Exactly. So what we've done, and again, this has been a joint project between several of us here at the Center for Commercial Agriculture and Gary Schnitke, who's a key member of the Farm Doc team at the University of Illinois. We've developed an options-based decision tool, and I'm going to explain why we call it an options-based, and I think sometimes that confuses people. We're really not referring to this from the concept of necessarily futures options that perhaps most of us in agriculture are familiar with, but really think about it more from the standpoint of, for example, in Indiana and Illinois and much of the Midwest, we have a significant oil and gas industry. And in the oil and gas industry, a lot of times a company will come out and want to lease a farm for a period of years, perhaps 5 years. And what they're really doing is paying a per acre option for the right but not the obligation to drill for oil or gas on that farm. And it might be several dollars an acre. In some cases it might be pretty significant. But they're really paying for an option. Well, really what's going on here is farmland rental arrangements are long-term often. In fact, the common refrain we hear when we do meetings around the state and around the nation is, if you give up a farm, you might not ever have the opportunity to farm that again. So the question is, would you be willing to pay an option premium for the right to farm that farm in the future when cash crop farming would be more profitable? And that's really the concept behind the spreadsheet. And what we've done in the spreadsheet is allow you to compute very clearly what that option premium is, and then, as Michael just indicated, how that would impact your liquidity and perhaps ultimately your solvency as you go forward. So let's walk through that. So we need some inputs. Michael, how about if you walk through some of the inputs for us?
The main inputs that we're going to need is primarily net returns and working capital. So let's talk about how we get to net returns and working capital. Well, we typically start with cost budgets. And we have cost budgets in the spreadsheet from 3 regions in Illinois and also low, average, and high productivity in Indiana. And so we've got some guidance there for costs, if you will, or some starting values is probably a better word for that. But we're really, really encouraging farmers to put in their own costs. Or if you're a lender out there working with a farmer or some other agribusiness person working with a farmer, put in costs that are applicable to the tract of land you're looking at even. So let's make very specific on these costs and try to be as accurate as you possibly can. Really think through what your costs might be for 2016 and enter that information into the spreadsheet. The other key pieces of information you're going to need is the revenue side. To come up with the revenue, we need some price forecasts and some yield forecasts. The yield forecasts are pretty easy to come up with. I see no reason why not to use trend yields for those, and so we'll show you how to do that in the spreadsheet. The harder one is prices. And so what we've done in the spreadsheet, and we'll illustrate this, is we've illustrated several different ways to think about price forecasts for the next 5 years. We've got low price scenarios, high price scenarios, and we also have a price scenario from FAPRI, an institute at the University of Missouri that does a lot of work forecasting prices. In fact, they forecast prices for the next 10 years. And so we've got some prices from FAPRI in that spreadsheet. And so that's another key ingredient. The other key ingredient here is working capital at the beginning of the year. We're expressing working capital on a per acre basis. And so you'd calculate your working capital, current assets minus current liabilities, and divide by your acres, and that gives you the working capital per acre. That's by far and away the most important information to put into the spreadsheet, and you want to make that accurate. And so if you don't have a good grasp on what your working capital is, here's your opportunity to calculate that as precisely as you possibly can, because as we're going to see, a lot of the thinking related to this premium depends on the working capital you put in there. If you have tremendous working capital, this is going to be a much different situation in terms of premiums than if you have very tight working capital. And Jim, this varies all over the board. You have farmers that have very little working capital today for various reasons, and you have farmers that have tremendous amount of working capital. And so this is very farm specific. The other thing we want to think about here is we can't predict the future, and so we're going to encourage people to look at different scenarios. That's why we've got several different sets of prices in the spreadsheet. So you look at least 2 different price scenarios. Maybe you look at some different scenarios related to working capital. Maybe you're thinking about making some changes in your operation that's going to provide more working capital. You can also look at sensitivity to working capital, but also costs. And so as we go through the spreadsheet, we'll show you different places where you're going to put in different cost assumptions, different price assumptions, and working capital.
And just to reiterate, we're going to give you some baselines to start with. So the spreadsheet has built into it several cost scenarios from either the University of Illinois budgets or the Purdue budgets, and you can use those as a starting point. But the one number that we absolutely don't have for you is the working capital number. So just to reiterate that is something you need to sit down and work through before you even try to use the spreadsheet. At least we would encourage that. We're going to talk about changing some of the other numbers because we really don't think you should use just our numbers, but they do give you a starting point. But that working capital number is going to be critical going forward. So let's talk about the outputs from the spreadsheet. It's going to compute a break-even cash rent. I've got that listed as number 2 on the slide. It will compute the premium of the market rent in your local community over the break-even cash rent. But that does require you to plug in number 1, which is the market cash rent in your area. We're going to start off by using, and when we go to the spreadsheet, we're going to start off by using some data from the Purdue Farmland Value Survey, which is conducted every summer. So that gives us a starting point. But again, it's critical for you to know your local market and plug in a number. If it's a farm you're currently renting, you obviously know what you paid last year. If it's a farm you're looking at renting, you've probably got a pretty good feel for what cash rents are running in your local market. You're going to need to put that number in. So, and then the key point, and then perhaps the contribution, the unique contribution of this spreadsheet, is it allows you to look at how your working capital changes over time.
Yeah.
And we're going to talk about a benchmark a little later on. We've got a benchmark to discuss, but it'll allow you to look at the changes in that working capital relative to the benchmark year by year, and I think that's an unusual thing, and that's actually something that we think is really important.
And Jim, one other point on scenario analysis, running scenarios or running what-if analysis. In addition to looking at a couple different sets of prices, I would look at a couple different cash rent scenarios. We typically start workshops by talking about, let's leave cash rent where it's currently at for the next 5 years. That's probably not going to happen, but you can see what would happen to working capital under that scenario. It's usually pretty ugly. Then you can look at a scenario, what happens if cash rent declined a little bit in the next few years? How would that impact my working capital? And so that's also a very important what-if analysis to run.
All right, so we're going to show a couple of screenshots from the spreadsheet itself, and then at the end of this webinar, we'll actually bring up a live version of the spreadsheet and just show you more completely how it works. So here's a screenshot of the budget portion of the spreadsheet, and you see that some of the items are listed in black, some are listed in blue. The ones in blue are ones where we've got a default value built in, but you have the opportunity to override that by simply typing in a new number above that. So if you look at it, and we'll illustrate this more clearly when we bring the spreadsheet up, there's where it says default budget. You've actually got a choice there. We've got 3 different budget scenarios for Indiana based on Purdue budgets. I think there's four different scenarios for Illinois. And if you're watching this from a surrounding state, you can simply look at the numbers and see how closely one of those might compare to your individual situation. Probably the easiest way to do that is to look at the default yield value that comes up. And notice when the Indiana high budget, the default yield value for corn is 198. That gives you a good idea as to how closely that compares to your individual situation. The Indiana average, I think, is built off 165 bushel corn, and the Indiana low budget is built off 132 bushel corn. So as you move around the country, and maybe you're not in Indiana or Illinois, you can pick off a scenario that maybe closely resembles your situation, use that as a starting point, and then start plugging in your own numbers. Again, we've got the details in there for individual items. Listed in blue, those are the default values coming in off that, in this case, a Purdue budget. But again, those are in blue. We're really asking you to look at your records and plug in your own numbers and make this as accurate as you possibly can, because ours are kind of stylized industry averages. Probably do a reasonable job of capturing a broad average, but for individual operations, as you pointed out earlier, Michael, they can vary quite a bit, right? So. This is on this the long run input part of this spreadsheet, and a couple of key points here. And as Michael pointed out, we're going to start off using trend yields, but one of the things that we want to do is think about, well, what is the trend? This is a multi-year analysis, so we don't want to use the exact same yield each year, and we know from looking at historical data that both corn and soybean yields tend to increase on average over a period of years. And the average increase varies a little bit depending on which budget you choose. For the Indiana high budget, we brought it in and said, well, based on the data that we had to look at over several decades, it looks like corn yields have been going up roughly a couple of bushels per year. And if you look at the budget up above there, 2016, 17, 18, 19, you can see how those corn yields are going up 2 bushels per acre per year. If you think that's a little too much, you can plug in a slightly lower number. If you wanted to plug in 1 bushel per acre or maybe 1.5 bushels per acre, you can do that. But I think the key point is, as you look at it on a multi-year basis, we want to make sure you're recognizing that in those out years, average corn yields are likely to be higher than they are today. And if you don't account for that, you're going to be biasing revenue downward in those out years, and we think that'd be a mistake in the analysis. So that's why that's built into the budget. We tried to make that easy, but that's an opportunity for you to make some changes. Michael mentioned the prices. There are several price scenarios built into the spreadsheet, and I'll show you how you can change those. But one of the scenarios is an opportunity for you to simply type in your own numbers, and that's what I've highlighted on the screen right there. So we've simply developed a user-defined scenario called we simply typed in 375 for corn throughout the 5-year period. You could plug any numbers you want to in there, but we wanted to make clear that you don't have to rely on one of the price scenarios that are built into the spreadsheet. You have an opportunity to play with some prices on your own. If you do that, I guess I should back up a little bit. It's a little bit hard to see, but where it says price scenario, and we'll show this later in the spreadsheet, it currently says FAPRI. You do want to make sure that the menu there is matching with the price scenario you want to use. If you want to use user-defined prices there, you should click on that and make sure where it says FAPRI at the moment, it should say user-defined, and that'll pick off the correct prices. We'll show that more completely a little bit later. Michael, you want to talk about cash rents?
As I indicated, there's an opportunity to change the cash rent assumptions from 2016 to 2020. Here we've left the cash rents at the same level. That's probably the first scenario to run to see what happens to working capital under that scenario. I would follow that up, of course, by looking at a scenario where cash rent drops from 2016 to 2020. We typically look at maybe a 5% drop per year when we're illustrating, but kind of use your knowledge of the local market and try to come up with a couple different cash rent scenarios there.
All right, this next number I think is one that we should dwell on just a little bit.
Yes, Jim and I were talking earlier at coffee, and this is a place where you don't want to put zero. Because most operators need at least some money from the farm in order to have any kind of family living. And so the way to calculate this logically is to calculate your family living expenses, add to that income and self-employment taxes, and subtract from that non-farm income. And so let me repeat that. You look at your total family living expenses, add taxes to that, and subtract non-farm income. For the Illinois farm business.
And then divide that through by the acres,
yeah,
right?
by the acres. The Illinois Farm Business and Farm Management Association, for example, that number has been running around $85,000 to $90,000 per operator. And so that's the kind of exercise you need to go through in order to calculate this number precisely. Now, we have a different place in the budget. We have hired labor. And so if you've got hired labor, you want to make sure that you add up all your hired labor and divide that by the acres. But don't put zeros in for these numbers. If you have zero hired labor, of course that's going to be zero. But don't put zero in here for operator labor because you need something there to cover your family living.
So just to make that a little more concrete, you used roughly $80,000 based on the Illinois Farm Business Management data. So if it was $80,000 a 2,000-acre farm, rough that out, it'd be roughly $40 an acre, right?
This $32 is based on 85 to 90,000 divided by a 3,000-acre farm.
Okay.
Approximately 3,000 acres.
So that gives you a feel for where that number's coming from, and it's not like you have to have that fine-tuned to the individual dollar, but you don't want to put a zero in there. And I know that's a temptation for a lot of people.
And I've seen this as high as $100 looking at the Illinois data. And so this varies tremendously across farms, and so don't use the default value either.
So the analysis part of the spreadsheet, which we've got on the screen now, and I guess I'm going to focus on the number that we mentioned earlier, which is critical. This is where you put in your working capital per acre at the beginning of this analysis period. So for our situation today, that would be your estimate of what that working capital is going to be on January 1 of 2016, right? So that will allow you to walk through the next 5 years. So this is where you want to sit back and actually have this number prepared before you start working with the spreadsheet, okay? The next section is down at the bottom where it says rent analysis, and it brings in the market cash rent that you put in previously. It computes what we're in the spreadsheet referring to as an equitable cash rent, or actually maybe a better term for that would be break-even cash rent per acre. And then the premium is simply, as you indicated a few minutes ago, Michael, is just going to be the market cash rent minus the equitable cash rent, and it's just going to be the premium of that above how much the market is above the break-even rent year by year. And those numbers are pretty big, at least on this example. And that's unfortunately the situation we're looking at in many cases across the Corn Belt. Then the last part is the working capital to total expenses. And we've expressed that as a ratio. So it's the working capital, dollars per acre, divided by the total expense category on the farm. And if you think about it, let's talk about what's a benchmark there that we should be thinking about.
Mike Bulgy likes to use 20%. I actually prefer a higher benchmark. I usually think 30% is kind of a number in my head. And so in this particular case, as we get to 2019, we've dropped below that 30%. Why is that critical? Again, if you're using all your working capital to pay premiums on cash rent, you're not going to have money for other cash shortfalls. And you're not going to have money to replace a machine that maybe needs to be replaced, or replace a tractor that maybe needs to be replaced. And so this is the key ingredient of this spreadsheet, is to see what happens in each scenario to your working capital to total expenses.
So let's talk about the benchmark again, because I agree with you. In this environment where returns are negative in many operations, and it's a very volatile kind of an environment, I would prefer to see people have a higher working capital to total expense ratio than you might have in an environment where returns are pretty steady. If you're in an environment where returns are pretty steady, that 20% is probably fine. In the current environment, we need to preserve working capital, and I really would encourage people to think about using that 30% as a minimum benchmark.
And I just want to note that this is a pretty solid working capital situation coming in. $500 would be a fairly high number for someone today, and so even given that we're starting with a very solid working capital situation, if we pay current cash rents in 2019, we're already below that benchmark. Let's talk philosophically, Jim, about even if you could afford to pay this premium, would that necessarily be a good idea?
Well, that's an individual decision,
Yeah.
right? And that's the purpose of the spreadsheet, is allow you to compute that and understand the premium you're paying and understand the impact it's having on your liquidity over time and ultimately your solvency. So there's some personal philosophy there, but as I look at those numbers, that's a tremendous amount of cash walking out the door.
Yes.
Year by year. Yeah. And I really think you have to ask yourself, am I willing to commit to that magnitude of an option premium to retain control of the asset? Because let's come back and think about why are we even talking about paying a premium? It's this idea that we want to retain control of the asset, in this case farmland, over a period of years, and it's based on an expectation that at some point in the future, cash crop farming, row crop farming will be profitable again on this particular property. But if you are absorbing these kind of large losses in the short run, the first couple of 3 years, for example, in this case, I guess we've got 5 years of losses on the screen. How many years are you going to have to farm that after that to recoup those losses?
Yeah.
Those are big numbers.
Yeah. Another way of looking at that, let's look at that $500 starting point, and then let's look at all costs included. Right above the working capital total expenses, all costs included. This would include operator labor and machinery ownership and all of the costs. That 119 number. What that 119 number indicates is we've sunk $380 into this tract to keep it. And so an individual farmer needs to realize, even if they have deep pockets, if you will, am I willing to sink $380 into this to keep that option of farming this ground in 2021 and forward?
And I know, Michael, when you and I have been doing some programs and meetings around the state of Indiana recently, we've had a lot of people come up at the conclusion of the meeting and want to have some one-on-one conversations with us. And you know, the question really, it does revolve around this, and the question becomes, what should I do in my situation? And you know, for a lot of people, our advice has focused on the idea that we do expect cash rents to come down. There will be some opportunities, if not the particular property you're looking at today, there might be some other opportunities in your community to rent, to increase the size of your operation going forward. So keep that in mind as you think about the magnitude of the losses you're willing to absorb.
And another
in the short
point
run.
is this really needs to be done on a tract-by-tract basis, because even if you have 12 or 24 landlords, if you're talking fairly good-sized farm, there might be only 1 or 2 that are really out of sync. And so what it really comes down to is, how important are those 1 or 2 tracts to my entire operation? If they make up half your operation, this is a lot different situation that you're thinking through than if they make up 5%.
And I guess, without dwelling on it too much, I guess that does kind of point out one thing that's not included in this spreadsheet, and this question comes up in a lot of our workshops and webinars, and that is the spreadsheet as it's currently configured does not calculate the impact losing a property would have on your overhead cost. And this comes up a lot, so you know, using the example you just used, you know, let's say this is a small component of your individual operation, maybe 5% of your total acreage. Okay, the impact on your overhead cost per acre is going to be pretty minimal.
Yes.
But if it's larger, if it's 10% or more, I think you have to stop and think about, well, how much impact is this going to have on my overhead cost per acre?
And here we're specifically talking about machinery cost per acre and family living per acre. Those are the 2 costs you really have to think about. And think about it, if this is 50% of your ground, those are essentially going to double your operator labor per acre and your machinery cost per acre. It's a fairly extreme case, but in that extreme case, those overhead costs per acre, machinery costs and family living costs per acre, would double. And so you really have to, when you're using this spreadsheet, you really need to think about that. How important is this track to my operation? It's really going to change the way you have to think about this premium.
Yeah, it really does. All right, so Michael, the bottom line?
I talked about scenarios on purpose earlier because we know you can't predict the future. We're not even going to try to predict the future in this spreadsheet, but we do encourage you to look at different scenarios so you can position yourself for any challenges and opportunities that may come up. Quite frankly, before I started looking at a spreadsheet, this particular spreadsheet, I wasn't thinking this decision through in a 5-year framework, and so that's one of the things that really helps you here is to think about this in a long-term competitive position standpoint rather than just looking at what should I do for 2016. Again, it helps you with challenges that may come up, working capital challenges, but also opportunities. You talked about that earlier. If you're thinking about maybe taking on another track that someone's giving up, put the information in the spreadsheet and see if that's an opportunity for you to pick up that track.
Yeah, very much so. So for the remainder of the webinar, what we're going to do is actually bring up the spreadsheet on the screen instead of using PowerPoint and just kind of walk through some changes so that you get a better feel for how this spreadsheet works. And I'm going to position my screen a little bit there. So I'm going to go to the budget section first. And I want to walk through a couple of things, just how the spreadsheet works. I guess first of all, when you download the spreadsheet, this is a macro-driven spreadsheet. So depending on the security settings on your computer, you might get a message on your computer that says, enable content. And the answer is yes, you do want to enable the content. And then the second one was, do you want to enable the macros? And the answer to that is yes, you want to say yes to both of those questions. Depending on your security settings, you might or might not see those questions. It should open up by default to the budget section of the spreadsheet. So I'm going to give you just a couple of navigation points. We've got a couple of macros in, and so you can navigate the spreadsheet. It's a 2-sheet spreadsheet. In other words, there are 2 sheets within the Excel worksheet. One's called budgets, one's called long run. If you click on the long run button up here, it simply causes you to switch sheets, right? So that's just a way to navigate. You can do it that way, or you can do it down below using the kind of the manual way to do it. So that's what that's about. The print is obvious. That just allows you to print the outputs or the inputs, either one. Where it says default budgets, I think when you open it up, by default, it will default to, I think, Central Illinois High, if I remember correctly. So when you open the spreadsheet, you'll have a set of budget inputs in there, and you probably noticed when I flipped from Indiana High to Central Illinois High how some of the numbers down below were changing. It's simply pulling in the budget that we've built into the spreadsheet for that particular location. So you can pick off the one that's appropriate for you. I'm gonna go back and use the Indiana High budget, which is the one we've been working with a lot. The second point is, as you look at some of the individual cells, and the Indiana High budget, it assumes that you're running a 50-50 corn and soybean operation over the next 5 years. If that's not the case, you can change it and simply indicate what percentage of the acreage will be devoted to corn, and then it'll automatically compute the soybean acreage to bring it back up to 100 for the combination. Yields come in off those budgets. So again, the way I would approach this, particularly if you're not in Illinois or Indiana, is to simply look at the yield per acre that you're looking at, that you think this property that you're evaluating is going to produce over the next several years, and pick the budget based on the yield number that's in there. That's how I would start. Michael?
I think a logical place to start, if you have crop insurance, you should know your trend-adjusted corn yield and trend-adjusted soybean yield. Put those in. What you don't want to do is say, well, one year I got 215 bushel corn and I got 65 bushel soybean. You don't put your highest yield in there. Because remember, it's going to take this yield information here and use it through 2020 with a trend yield adjustment. So I think starting with a crop insurance trend adjusted yield is a very logical way to approach this.
The next item is going to be the futures price, and you can tell we put this spreadsheet together a couple of months ago, actually.
Yeah, several months ago.
So the default values are a little on the optimistic side. So let's plug in something that's more realistic there, Michael.
Let's go with 390 corn, Jim.
390 on future. This is a futures price.
Yeah. And let's go with 890 on soybeans.
Okay, we're going to plug in 890. So you can just type in a more realistic number that you want to plug in,
and you change your basis.
Same way with basis. We've plugged in a negative 30 cent as a starting point. I would recommend putting in an average basis for your particular locale. So we're going to stick with 30 on our spreadsheet.
Notice, Jim, we should point out there that in that language in red, that it says that the budget inputs vary from defaults. That's not a problem in this case, but as you change it, that will show up.
And if you want to go back to the defaults, let's say you want to run another scenario, you can simply click that Use Default button, and it will bring back in the base budget for whatever location you picked in that up there in yellow. So you can do that. So it'll compute the revenue. I'm just scrolling down here. Total revenue. Here's some of your individual expenses. Those are in blue. So again, remember when they're in blue, we've grabbed a default number off either Purdue or Illinois farm management budget, but this is an opportunity for you to put in your own numbers, and we would encourage you to do that. Your results will be a lot more accurate if you use your own numbers. So you can look at that based on your results for the past year and your budgets for upcoming years. Michael, there's probably one number we probably ought to maybe talk a little bit about, and maybe that's machinery depreciation.
Yes, this number is going to vary a lot across farms too. And this is a number you might want to run a couple different scenarios on. I would start by looking at your machinery depreciation that's currently in place. Calculate what your machinery depreciation is for corn and soybeans, and if it's different, try to calculate the differences. Here is showing a lower depreciation for soybeans, which is realistic for a lot of farms. But you also may want to look at a scenario where you're saying, well, I'm not going to be replacing tractors, combines, or planters in the near future, and so I'm going to live off my depreciation, if you will. This is the place where you'd enter that assumption. You'd reduce this a little bit to reflect the fact that you're not going to be buying any machinery in the next few years.
Yeah, so, and again, we would caution you against pushing that all the way to zero.
I would not put zero in there.
Yeah,
because you still have the machinery out there that you've invested in. That's not zero.
But it is an opportunity for you to think about that, particularly when you're looking at it on maybe a 3 to 5 year basis. We've got some other inputs there. I think most of those are pretty straightforward. And this is where you could put the cash rent, your current cash rent, or maybe your market level cash rent on the property that you're evaluating. So we had that in at $295. Yeah. That was the actual cash rent off the farmland survey for actually 2014.
For 2014,
right? And actually, so we might want to put in the 281 there, right?
Yeah, let's put in 281 or something like that.
I think that's the number off 2015 off the Purdue budget, or off the Purdue farmland survey. So there's your net return per acre using that particular budget, that particular yield, and that set of prices for 1 year.
That doesn't look real good, Jim.
It does not look real good. All right, so now we can switch over to the long run budget, which is actually where we can start looking at some scenarios.
Let's show the break even, Jim.
Yeah, okay. Oh, and we forgot about crop insurance.
Yeah, you can see down below there that there is some break evens calculated there. Again, we focus on the all costs included. That would include all your overhead costs and your variable costs. In this case, break even for corn is $4.35 and for soybeans $10.65. We're not going to dwell on crop insurance and ARC County payments today, but below the budget here, below the break-even price, you want to put your county in there because that's going to help you calculate what the expected crop insurance would be and what the expected ARC County payments would be. Yeah. Now remember, for 2016, Jim, the ARC County payments are going to be quite a bit lower than what they're likely to be for 2015. And so for some scenarios, those ARC County payments are going to be zero.
In fact, I would argue if you're using the spreadsheet appropriately, most of the time they're either going to be zero or very close to zero.
0 to 25 is typical numbers that I come up with different scenarios.
Yeah, and the reason is because of the way the budgets are built. So if you're using a multi-year budget, you're not forecasting a significant drop in revenue relative to the benchmarks, which would trigger those payments. So,
and then crop insurance too. I mean, you're not going to be able to forecast a drought in 2019, and so your crop insurance, you'd expect that to be zero too. But nevertheless, that information's in there. So make sure you enter the appropriate county of your tract.
And pick the state and then the appropriate county, and then you'll get our best estimate. Let's put it that way. So. But we don't think for most situations that's going to have a big
It
impact.
actually we actually are showing a small ARC payment for corn with these numbers.
Yeah. So let's see. So now I'm going to click on the long run analysis button. That takes us to the other sheet, and we had this up on the slides earlier. So here's where you would, if you wanted to change the trend for either corn or soybean yields on a year-by-year basis, you could override the number that came in from the budget.
Don't be overly optimistic there either. Looking at average yields in Indiana, those numbers that are on that spreadsheet are very close to what we see. And so using something over 2 for corn and over a half a bushel for soybeans is probably not realistic.
Yeah, so you can play with those a little bit, but I wouldn't get too carried away either on the downside or the upside, either one.
Yeah, using a bushel wouldn't make any sense either because it's higher than that.
Let's talk about these price scenarios a little bit because this maybe is a little bit confusing. So as you look at the prices, we've got several price scenarios built into the spreadsheet that you can use. And the first one's labeled FAPRI. And so I'm going to go down to this menu and click on FAPRI. And notice when I did that, what it did was it took down here, the prices in this row now match the prices in the FAPRI row up here. So that tells you that the spreadsheet is now using the prices from the FAPRI scenario. If, in contrast, I wanted to use the prices that we've listed here in the user-defined scenario, and they just happen to be some numbers that were in the spreadsheet when we opened it, but I would want to click this menu down here and change it to user-defined, and now notice that the prices here, which are the prices that the spreadsheet's actually going to use to compute the various scenarios over the next 5 years, match the numbers here. So it's important, and I think I've worked with one or two people that plugged in some numbers in user-defined, but didn't remember to change the menu down here. And the problem with that, of course, is it's not using the user-defined prices. So the way you can check is these are the prices the spreadsheet's really using, and make sure they're the ones you want to use for the scenario you're trying to analyze or review. Same story on soybeans. So those are the corn prices. You do the exact same thing here with respect to soybeans. Cost changes. Michael, this is a little bit like the trend yield. So over long periods of time, we know that costs have been going up per acre. However, the next several years, what's likely to happen?
Yeah, the cost increases, particularly for some cost items, have been rather large since 2000. Particularly the last 10 years, they've been rather large. But for the next 5 years, they're probably either going to be flat or slightly down. And so that's why we've started with 0 here, to kind of reflect the fact that the pressure for the input prices to increase is not near as strong as what it was even 2 years ago.
So this would be an opportunity, and as Michael indicated, the default we put in there is 0. If you wanted to get a forecast in of cost going down, let's say you're optimistic that fertilizer prices are going to go down and maybe seed costs are going to go down over the next several years, you could plug in a small percentage decrease here. Again, it's a little bit like the trend yield scenario. Don't get carried away.
Yeah. And it's not, for costs to go down 1% per year from 2016 to 2020, based on history, is not realistic. Sometimes they go down. First of all, it's fairly rare that they go down. But if they go down for maybe a year or two, and then they're either flat or slightly up. And so I think starting with 0 for a scenario is probably logical.
Yeah, and that's why we built it as the default value. I think we could make a case for perhaps fertilizer values coming down the next several years. So we could build a case for seeing costs come down a little bit the next several years. But I think the key is don't get carried away. And remember, if you put a 1% in there, it's going to go down 1% every year.
Yes.
So it starts to build on itself. And
that's going to be more in fertilizer. It's going to be multiple costs. And so,
yeah.
And so if you're, for example, if you think in 2016, if you're looking at 2016, well, my fertilizer costs are lower than they were in 2015. Put that over in the budget. But that's reflected over in the budget, not here.
So just to see how that works, I just plugged in -1%, and notice what that did to cost per acre. So in year one, it had it at 540, which is unchanged from what we had before, but then it's got 2017 going down a little bit and so on down the line. So that 1% takes you from 540 in 2016 to 519 in year 2020. So you can use that and plug in whatever you think is appropriate. I'm going to stick with 0 for our scenario, but that's something you can look at. Let's see. So down here, here's the projected cash flows. You've got the revenue. This is where you would, again, this is in blue, so this is the cash rent, the market level rent, and this is where you would plug it in for the multiple years. The 281 did come from our budget number that we had on the budget screen a few minutes ago, so that's where the 281 came from. And you can start playing with that. So let's say, this is where you get a chance to look at how things might play out over a period of years. So you could, as Michael indicated, you might project cash rents coming down for the next several years, and you could do that. You could look at what would happen if rents stay where they're at today, which I think is a useful first scenario to look at. I encourage everybody to look at it that way initially and then start making changes from that. Here's our operator labor, and that's coming in from the budget on the previous page. And again, you could change that a little bit. So if you keep scrolling down, and here's our break-even rents. So you want to walk through those, Michael?
Yeah, the all costs included is the one we want to focus on here. And notice it is increasing over time, but it's quite a bit below our market cash rent there. And so that means that the premium is going to be quite high. As we continue to scroll down, the premium is going to be quite high. It's getting a little smaller over time, but nevertheless, it's still pretty high even in 2020.
Yeah, and as you look at it, you can kind of see what's going on here. Here's our farmer net return of minus 119. And there's the break even, and that's triggered off of the cash rent of 281. That's the difference between those two numbers. All right. So we plugged in, as we did on our slide a few minutes ago, we started off with working capital of 500. All right, so that was a number that we came in from our own individual
and in
financial
2018,
statements.
we're already below that 30%. And another way of looking at that, go one line above. You see that $199. That essentially means that we've lost $300 per acre of working capital already in the third year. And so again, paying really high premiums is something you really have to carefully think through. But this is kind of the way to look at different scenarios. This scenario does not look very good, but remember, we've kept cash rents where they are currently. Jim, are we ready for a scenario where we drop cash rents a little bit?
So let's just walk through one more thing before we do that. So down here below, just for kind of straightforward analysis, this is the premium above the break-even that this farm is paying on a year-by-year basis, right? So 119 in year one, and then because of the price scenarios we had in there, it looked like it was
price
getting
is
a little
going
bit
up
better.
and yield is going up, and so we do get the smaller premium over time, but it doesn't decline very much.
Right. So the revenue situation was improving, and that's why those were coming down a little bit. And then, as you pointed out, the working capital was shrinking pretty rapidly. All right. So let's go back and look at a scenario. In fact,
and that would not be a sustainable working capital scenario.
So when I do these, Michael, you may do them a little different than I do. I kind of like to look at one scenario that's maybe not a worst case scenario, but certainly worse than some of the long range forecasts that are out there. And maybe a starting point would be to just say, well, what happens if corn averages maybe 375 over the next 5 years? And I'm just going to plug in those numbers across the board.
This won't be pretty, Jim.
But no, it won't be. But it's illustrative of something that could happen. I'm not forecasting this per se, but it is something we need to think about, right? And if I'm going to do that, so I want to make sure the menu says user defined. It does. So it's grabbing those 375s that I just plugged in, and then I need to do something comparable on soybeans. If corn's going to average 375, Michael, what do I want to use on?
Probably 850 is not a bad starting point.
Yeah. if I want to...
That would be very conservative soybean forecast, but nevertheless, that's the whole idea with this scenario. I think you got a typo on that one.
Yes, I do. Again, I want to make sure it's the user-defined scenario. It is. I checked the prices down here, and yeah, that's matching up, so it's grabbing those user-defined prices. I've still got cost not changing. I'm going to leave the cash rent where it was, and of course, in that scenario, those net returns are very negative. The premium that we're paying to retain this property above the break-even rent, quite large throughout the period. And of course, the working capital collapses very quickly.
Yeah, we pretty much exhausted it by year 4, but before you got that, the lender would probably cut you off, maybe in year 3 there. And so it's just another scenario. If prices stay relatively low, working capital gets eroded very quickly.
So that gives
us... With current cash rents.
With current cash rents. So now let's look at a scenario where cash rents start to come down. Because truthfully, that's what we think is likely to happen over the next few years.
So let's just take $10 off of that per year. That's...
So start with 281 and then start...
270, 260, and so on. They could come down more than that, but let's just kind of a place to start. That's not a real large... We're not assuming a real large drop here. It's just to illustrate how to use the spreadsheet.
So it looks a little better.
It looks a little better, but that's not going to be enough.
But our working capital erodes pretty quickly.
Under those prices, that's not going to be enough.
With that price scenario, right. And so let's say, let's see, 10% would be 28.
Do $20. So why don't you just do 260, 240, and so on? I actually think this is a more realistic scenario of what may happen if prices are really low, and in fact, it may not be dropping enough here. It go to 220 and 200 at those out years, Jim.
Yeah, you're right. So here's our premium that we're paying above break even.
Still tight working capital.
And yeah, here's the working capital analysis. And if we're going to use that 30% as our target, we've dropped below that at the end of 3 years.
Yeah.
So you know, a scenario that might be a little more realistic is to keep prices maybe in that 375 range in year 1. A lot of the forecasters are suggesting the out years are going to be a little more positive. I think the scenario we had in there initially might have been a little more positive than perhaps I would like to plug in. But let's maybe gradually get things coming back a little bit, and maybe 395, and maybe the out years maybe just sit on $4 and see what that looks like. And then I need to do something similar on soybeans. Probably keep that one there. Maybe about 870, maybe about 890, maybe 9, maybe 910. And again, these really aren't forecasts; are just a scenario to look at. Okay, that's starting to look a lot better, because in the out year, we finally get back to something that's pretty close to break even, right? So our premium there was only $4 an acre.
And you can see there the working capital in this case is getting close to that 30% benchmark, but it's staying above that.17
as you pointed out earlier, Michael, even in this scenario, we took working capital that was $500 an acre, and at the end of 16, 17, 18, at the end of 19, we took 500 an acre and turned it into 200 an acre.
Yeah, it's $300 per acre of working capital eroded.
So that's a big erosion.
And so
in
even in this
capital.
case, let's go back to our philosophical discussion earlier. Even in this case, if you thought that you could afford to pay these premiums, that does not necessarily mean you want to pay these premiums. Again, it's going to be very, very much up to the individual farmer what they decide to do here. But you just really have to ask yourself, do I want to erode $300 per acre of working capital to keep this piece?
Yeah. So I think our time is about up, Michael, and I think maybe that's a good place to end. I think you and I have been doing a number of meetings around the state of Indiana here recently, and we've been hearing a lot of stories about cash rents. Certainly, I think this week we heard several stories about cash rents of still remaining well above $300 an acre, and admittedly, probably on some high productivity tracts of land. But that would imply, based on our analysis, probably some pretty significant premiums above a break-even rent being paid by some individuals. And so I guess our parting comment here would be, we hope you found this useful. We hope you take the time to download the spreadsheet. We really do want you to use your numbers, and I just can't emphasize that enough. The Purdue numbers or the Illinois numbers are a reasonable starting point, but it's really imperative that you spend some time looking at your individual cost situation, because for a variety of reasons you could have some differences that would make things look different for you. And as you think about either renewing a lease on a tract of land that you currently have, or think about perhaps bidding on a tract that might be coming up for rent in your community, think very carefully about the long-run impact on your operation, and that's really what this spreadsheet tool is all about. It's not about teaching you what the appropriate rent is. That's an individual decision. But make your bid and make your negotiations very well informed. And then I guess the last point, Michael, and I know we've got some landowners watching as well, not just farmers that are leasing land. The other thing that can be done with this spreadsheet is to make people that you're working with better aware of how much the economics of crop agriculture have changed these last couple of years. We've gone from a period of very profitable operations in row crop agriculture here in the Midwest to a situation where losses are really quite large potentially here, not only in 15, but looking at the next couple of years. So it's a very challenging environment, but not everybody understands that very well. And I think the spreadsheet can be a tool that you can use to maybe help people better understand the changes that have taken place and maybe make some changes going forward. So with that, on behalf of Purdue Extension and the Center for Commercial Agriculture, I want to thank you for joining us today, and I certainly want to wish everybody a Merry Christmas and a Happy Holidays. So thank you.